Mark Luschini, the chief investment strategist at Janney Montgomery Scott. Mark says growth will be meandering, but there is money to be made in healthcare, technology, and financials. Mark joins us now from Pittsburgh. Good morning, Mark.
Good morning, Scarlett.
So let me get this right. You like healthcare, tech, and financials. We're talking about a defensive sector, a cyclical sector, and the group that's arguably hardest hit by the crisis and the ongoing turmoil over in Europe. What is the common theme here?
Well, absolutely. The common theme is valuations, which are exceedingly cheap across those three sectors. Healthcare is one of the cheapest sectors by far on a pure valuation basis. Technology, the same, although I think technology's earnings growth are expected to be a little swifter than that of healthcare. So I think the two of them together give you a little defensive hedge as well as a pro-cyclical hedge. And then when it comes to financials, it's by far the most bombed out sector among the 10 primary in the S&P 500. And we've begun a theme of, if you will, fading the go global orientation in client portfolios and reasserting some more domesticated positions, and think that financials in the U.S. may be benefiting from the pullback in European financial institutions.
But within the financials, Stephanie Ruhle was just telling us about how these big banks are having to cut costs by firing a lot of employees. Wouldn't that mean that the big banks in particular have a lot more costs to cut, including perhaps selling off some businesses, and perhaps the regional banks that would benefit from a pickup in global commercial banking would benefit a little bit more?
I think there's probably a good chance of that. I would, though, not dissuade somebody from considering a bank like a J.P. Morgan, which continues to grow nicely, as well. Goldman Sachs is one of the two universal banks that I think are going to benefit from an uptick in activity just on a global basis, even if growth is relatively slow. And really, if you will, complement that with the regional banks that are also, hopefully through some stabilization in economic activity in the U.S., which seems to be warming, should continue to see deposit growth and some stabilization in their loan portfolios if we see some steadiness brought to the housing market, which we think could be a 2012 affair.
Now, we had a Bloomberg poll recently that surveyed investors around the world, and it showed that they picked the U.S. as the best opportunity. It sounds like you're describing a decoupling going on between the U.S. and Europe, and I take it that that's something that will gather momentum?
Yes, we think so. In fact, we went into 2011 thinking that the U.S. equity market was going to be among the best performing bourses in the world, and continue to hold to that theme. We think, again, we see activity starting to pick up here in the U.S., hardly robust, but nonetheless, at least directionally positive. While at the same time, we look at emerging market economies of interest, but slowing in some cases. China's cooling, and Europe, which we think is going ice cold. And so as a consequence, we want to position portfolios a little more domesticated, but as well to continue to tap those emerging market economies, but be sensitive to our exposure directly to Europe, because obviously they're either in the midst of, or we think soon will be in a recessionary condition. It's only a function of its severity.
Right. It's a matter of how much, not when. Now, if Europe is in recession, and that is priced in to some extent, how much is a Chinese hard landing priced in, or a slowdown in the rest of the emerging markets?
Well, I don't know to what degree that's priced in. I think the consensus seems to be that they're going to be able to execute a soft landing, and we happen to fall in that camp as well. They have a $3 trillion war chest in their surplus that they can put to work in the event that they do step on the brakes a little bit too hard. But clearly at the moment, conditions there are slowing, and some of it was deliberate, but the backdraft consequences to their slowing is having a ramification to other emerging market countries that rely on China's growth to export things like food and rocks.
Okay, let's bring it back home for a moment here and talk about healthcare companies. There was a B of A survey of chief financial officers recently, which showed that those CFOs are most concerned about rising healthcare costs next year. Who in the sector has some kind of pricing power right now?
Well, I think you have to search pretty far to find, but a couple of things we like in that space, because we think it's discounted some of that. On one hand, we like the pharmaceutical companies, if only for their fat dividend yield, even recognizing that they're utilities at this juncture rather than growth franchises. And the other is some of the medical device companies that are going to be subject to increased pressure on pricing and obviously margins as a consequence. But nonetheless, valuations among companies a name like a Medtronic, for instance, or a Covidien, we think are exceptionally inexpensive, have largely reflected already those pricing-related issues. So we're, rather than saying who's going to be affected, trying to account for those that maybe already have baked in the consequences of those pressures.
Okay, and Mark, just very quickly here, let's touch on technology stocks, because Zynga is, of course, going to go public today. Facebook is the next big IPO to come out. What's exciting for you in the tech space beyond valuations?
Well, free cash flow yield, that is enormous, and the amount of cash that's sitting on the balance sheets of some of these institutions. I mean, the one bright spot economically here in this country in terms of its contribution to GDP growth has been business spending, which we do expect to continue. So we look for some of those franchises that have been laggards, clearly. A name like Microsoft, for instance, with, $50 billion in cash, an upper single-digit free cash flow yield, paying out a 3+% dividend yield with the propensity to raise that going forward, looks like a place to be that we can feel comfortable with a cheap valuation in the technology space, a benefactor of business spending, and some stability should we get further turbulence here in the equity markets, which unfortunately we do expect as we continue to be held hostage to the events that are exported to us from Europe.
Yeah, that seems to be the one certainty everyone has in mind for 2012. Thank you so much, Mark Luschini of Janney Montgomery.